I read your piece with a great deal of interest, and the question I was instantly left with was, given what we've just seen in the regional banks in the United States, are we facing a situation where we need new regulation, i.e. a complete rethink of the way that we regulate the banks, or a complete rethink of how strict we are with supervision? Is what we're seeing now in the regional banks in the States just bad management and requires better supervision, or a precursor to the start of a debate on whether or not we need to completely reform regulation?
Well, I don't think that supervision as such is the answer. I mean, we want banks to operate as private sector institutions, making their own judgments about to which firms and individuals they lend and how they finance it. If they make mistakes, then they will fail and they will disappear. We have a resolution process for trying to ensure that that happens in a fairly smooth way. The real problem, I think, is that either for good reasons or often for bad reasons, banks find that they simply don't have the cash to meet the demands from those who wish to take their deposits away or who no longer wish to provide short-term funding to banks. And even if the bank is fundamentally sound, they won't have the cash to meet those calls. And in a crisis, the only source of cash is the central bank.
Lord King, is there something to be said for the fact that banks should just be really boring? And they just sort of lend the money out, they just park it, they don't really make a ton of return, and we leave the real borrowing and the real lending to like private equity, where you do lock up funds for a decade?
That would be a dramatic change for the entire system. And I think it would take a long time to achieve. We don't have institutions in the private sector that can easily step in to replace banking lending, bank lending.
Yeah.
I don't rule it out, but I do think it would be much more sensible to do it in stages. And the real first stage is to ensure that when a bank needs liquidity or cash, that it can turn to the central bank, knowing it is certain to get it. But you can't make a open-ended commitment from the central bank to provide it, which is why the central bank has to look at the individual bank and say, look, I can see the loans you've made, the assets on your balance sheet. In a crisis, we would lend you a certain amount against it. Like a pawnbroker won't lend what everyone thinks might be the full value. There would be what's called a haircut imposed on the potential supply of liquidity from the central bank to the commercial bank. But everyone would know what was the maximum amount that the central bank was prepared to lend to a bank. And the rule would have to be that the bank cannot issue more deposits or very short-run liabilities than the central bank is willing to lend to it. And that would eliminate bank runs at a stroke. And I think it's the direction in which we need to go.
So what you're basically suggesting is a prepositioning of assets. That would ostensibly maybe deal with the liquidity issue. Does it deal with the solvency problem, which sometimes follows quickly on its heels?
Well, it would deal with the solvency problems that result from a shortage of liquidity, yes. And you're quite right that sometimes banks appear to fail not because they're fundamentally unsound, but because they don't have access to cash. It would deal with that problem. But it's still the case that banks can make irresponsible loans or just be very unlucky and then lose a lot of the equity funding which they had started with and then go bust, essentially. And you can't rule that out, as in any private sector enterprise. But there is now a new bankruptcy procedure for banks, the resolution process, which deals with that situation. So,
Lord King, based on that, if we take your model, what happens to the smaller banks? Are they able to lend as much? Like, do we see what kind of contraction in lending might we see if we take a pawnbroker approach to banks?
There would be some constraint on the extent to which banks could borrow short and lend long, or to invest in very risky loans. But it would be, at this stage, a relatively small constraint, because the consequence of doing so much quantitative easing by central banks is that the total amount of reserves held by commercial banks with the Fed or other central banks is essentially at an all-time high. So this will be a very good moment to introduce the scheme, because it wouldn't imply much constraint now. And what I would be reluctant to do is to make such a dramatic change to the banking system that you would throw out the baby with the bathwater. We can finance investment more cheaply now by allowing banks to borrow at the short end and lend long term. And that we want to retain. But if we're prepared to constrain that to a limited extent, so that central banks are always willing to lend to a commercial bank, then we get the best of both worlds.
Let's, Lord King, if we may, switch hats. One of the reasons you could argue that a number of banks in the United States have got into trouble is the rapidly shifting rates landscape that they have experienced. And one of the reasons for that rapidly shifting rates landscape has been that central banks have in many ways failed to get a handle and an understanding of what is happening with inflation, and therefore have talked of transitory and then had to rapidly readjust and raise rates very, very quickly. Many central banks have apologized, have issued a mea culpa on what went, and are now saying they're going to look at what went wrong. The Bank of England, in some ways, hasn't done that recently, despite the fact that it seems to be all over the shop in its understanding of why inflation is where it is and why it is as sticky as it is. Do you think the Bank of England needs to be a little bit more contrite in what it is saying right now?
Well, I don't want to suggest what the Bank of England should or should not say. I think the chief economist has been pretty open in saying that QE went too far. And I think that deep down, the ultimate mistakes are not those of central banks or the individuals in it, but of an academic view of how to set monetary policy that basically assumed from the very beginning that if inflation moved away from the target, it was bound to be purely transitory. In other words, their theory of inflation was, if we say inflation will be low, then it will stay low. Well, that's completely circular. And that is not a satisfactory basis for setting monetary policy. But I think the failings started in the academic world, and central banks became almost a victim of what was an intellectual consensus.
But they are basing their forecasts on economic models that derive from, as you say, some of this academic work that is being done, and the bank uses market rates as a big portion of that. Lord King, you must be looking, though, at what is happening with the Bank of England and slightly scratching your head. The Bank of England has gone from forecasting a very deep recession to then taking that recession completely off the table. And a lot of people are questioning whether or not the bank has a good handle, whether Ben Broadbent has a good handle on what is happening here and whether or not it has a handle on where the economy is going from here. What is your assessment there, given what you just said?
Well, I think the mistake that was made was to just assume that inflation would somehow automatically come back towards the target after the short-run deviation following the Russian invasion of Ukraine. And I think what that overlooks is that there were conditions in the economy resulting from a very rapid extension of quantitative easing in 2020 and 21 that made no sense. I mean, we had a situation in which the ability of the economy to produce had been significantly cut as a result of lockdown and other measures to prevent the spread of COVID. Mm-hmm. And it'd be very strange in those circumstances to say the right answer is to boost demand. If supply falls, you need to keep control of demand and not to do QE to expand it. So I think that was clearly a mistake that all central banks made.
Yes.
But I also think that the circumstances of a pandemic and what's been happening in Ukraine mean that it is foolish to try to pretend that one can forecast accurately. And I think that to make point forecasts of GDP growth and inflation, inflation will be 3.1%, whatever, that's far too precise. We do not know enough about the future to make those forecasts. So what we need to do is to identify risks.
So to that point, Lord King, do we need to be more flexible on those forecasts? Like, can we live with a 3 handle on inflation? Should we tolerate a higher level of inflation for longer?
I don't think we should change the inflation target. Our objectives should remain the same. But if you suddenly find there is something which you had not anticipated that occurs and inflation is pushed up, then the question you need to ask is, well, when do we think it will come down? Will it come down of its own accord? Or do we have to take measures to bring it down? And if so, how long will that take? And I think one of the unfortunate consequences of being belatedly recognizing belatedly that the inflation was not just the result of higher food and energy prices, but did require an offset to the monetary injection that was made in 20 and 21, was that central banks got behind the curve, and that has led to more difficulty in ensuring that domestically generated inflation in the form of higher wages and prices, that's just protracting the thing for even longer. And so I think it's a difficult position for central banks. But what I do think is a problem is that since the intellectual framework they were using has rather collapsed with the recognition that inflation isn't just determined by the target, what they're now doing is actually looking at the inflation numbers themselves. And the problem with that is that that's at the end of the chain. There are long lags between, as one of your correspondents mentioned just now, there's a long lag between when you change policy and the effect on inflation. And it may well be that the monetary overhang which was created has unwound to a significant extent. But we need to look at variables like the growth of money to get some feel for what may happen in the future. The inflation numbers are giving a backward-looking view, not anticipating where the future might go.